AI is the future, and we see it everywhere we go. We see massive amounts of money flowing into data centers, chips, and bigger AI models. We see companies like OpenAI and Anthropic that are worth hundreds of billions of dollars. With all of this at hand, it's very easy to conclude that capitalism may have found its next industrial thing that will push its profits for the next century or at least decades to come. But for Scott Timcke, this is simply not the case. He says the AI boom, rather than a sign that capitalism is healthy, is actually proof that capitalism is struggling. In fact, he says AI spending looks less like the start of a new golden age and more like a symptom of a system running out of good options. This is Polity. Let's get to work. According to Karl Marx, when companies compete with each other, they try to cut out costs by replacing workers with machines. Marx called this ratio of machines versus workers the organic composition of capital. Keep this term in mind, it's important. Marx argued that only human labor creates new value in an economy. Machines don't generate profit by themselves. They just help workers produce more faster. So when companies spend more on machines and less on workers, profits eventually get squeezed. This does not mean that machines are inherently bad for an economy because it replaces human labor. The problem is structural rather than moral. Apparently, this idea of Marx can also be observed in the rising AI industries of our time. Training GPT-3 in 2020, for example, cost around $5 million. By 2023, training GPT-4 reportedly cost around $100 million. Some estimates say the next generation of AI models could cost $500 million to a full $1 billion just to train before you even count data centers, electricity, and staff. Only a small fraction of this capital flows directly to workers. The rest of it flows to the building or acquisition of hardware required to produce an AI model. Examples are chips, power plants, and cloud infrastructure. Even highly paid AI researchers are a tiny slice of the total bill compared to hardware and energy costs. And this tendency that AI industries seem to exhibit is a very good example of a rising organic composition of capital, of how capital piles up in machines while the human labor share shrinks. Once an AI model is trained, it can answer millions of questions for almost no extra cost. At first, this sounds efficient, but this creates a strange problem. Companies spend billions before they earn a single dollar back. Then they need to sell access to their AI cheap enough that people will actually use it, but expensive enough to eventually pay off that giant upfront bill they spent on hardware. Compare that to a regular factory where each new product costs a fairly predictable amount to make and sell. AI industries don't work that way. The upfront cost is enormous, but the profit they get for every new release is tiny, which makes AI more of a gamble than a long-term investment. The problem is that companies are betting that future revenue will somehow catch up to the mountain of money they already spent, but so far it hasn't. Consider OpenAI. Its valuation reportedly hit $300 billion, while its revenue was around $12 billion a year. That's a huge gap between what investors think the company is worth and what it's actually earning. Anthropic's numbers tell a similar story, with its valuation many multiples higher than its yearly revenue. Marx had a word for this kind of gap between paper wealth and real earned value. He called it fictitious capital. It's not fake in the sense of made up, but it's a claim on profits that haven't been earned yet. Sometimes those claims turn out to be right. Oftentimes, especially in a bubble, they don't. The dot-com crash of the early 2000s followed a similar trend. Investors poured money into internet companies, convinced that higher returns on investment is guaranteed. Many of those companies collapsed. A few survivors like Amazon eventually became giants, but only after years of losses. Timcke argues AI could follow a similar path, but with some important differences. AI requires way more capital than a website did in 1999. Governments are treating AI as a national security issue, not just a business trend. And unlike the early internet, AI faces real physical limits. For example, companies are already running low on quality training data, and progress from each new model has started slowing down. GPT-5's 2025 release, for example, didn't blow people away the way earlier releases had. Tim pulls in an idea from historian Giovanni Arrighi about how global superpowers rise and fall. Arrighi studied past dominant economic powers like the Dutch in the 1600s and the British in the 1800s. Based on his conclusions, when a superpower's industries stop producing strong profits, capital doesn't just disappear, it moves into finance and speculation instead. Businesses stop building factories and start playing the stock market. Arrighi called this shift financial expansion, a signal that a power is in decline. Timcke called this stage hegemonic autumn. Let's take the British Empire for example. As German and American factories outcompeted British industry in the late 1800s, British capital increasingly flowed into banking, loans, and colonial investment instead of domestic manufacturing. The finance sector thrived even as British industrial leadership faded. Right now, the United States is going through this similar path. After the 1970s, American manufacturing profits declined. Money shifted towards finance, real estate, and speculation. By 2006, finance made up around 40% of total corporate profits, up from just 10% in 1980. After that came the 2008 financial crisis. Timcke argues AI investment fits this exact tendency. Yes, it involves building real infrastructure like data centers and power plants. That looks like a productive investment, but the sky-high valuations, the persistent losses, and the reliance on constant new funding rounds instead of actual profit look a lot more like an unsustainable financial speculation marketed as the future. In other words, the AI boom might not be a sign of American economic strength. It might be a sign of American economic strain to attempt to search for new profits after old industries stop delivering. The next important question we should ask is, who does the physical work that makes AI possible? The short answer is global inequality. Computer chips are designed in the United States but manufactured in Taiwan and South Korea. Raw materials get mined in Africa and Latin America, often under harsh and underpaid conditions. Software testing and coding get outsourced to workers in lower wage countries. Then there's data labeling, where workers were tasked to tagging and sorting the data that trains AI models. Workers in countries like Kenya, for example, reportedly labeled some of this data for as little as $1 to $2 an hour. Economists call this pattern an equal exchange. It's where wealthy countries capture profits, while workers in poorer countries provide the labor at a fraction of its value. And for the current case of the AI industry, this inequality is being intensified. Some people assume that if the US fails, China will simply take over as the next global leader. Timcke pushes back on that too. China has invested aggressively in AI by offering subsidies and coordinating development across provinces. China's strength rests in manufacturing scale, strong state planning, and companies like Baidu, Alibaba, and ByteDance building competitive AI tools. DeepSeek's surprise release in 2025 showed China can compete even with restricted access to the best chips. But China faces its own limits. The most advanced chips are made by Taiwan's TSMC, which is a dependency China hasn't solved yet. China's growth model also relies on keeping domestic wages low to fund exports, which weakens the very consumer demand that historically helped the US maintain global economic leadership. The thing is, for a country to be a global leader like the US, they had to be who the world depends on demand, trade, and finance-wise. And for China, they still haven't reached that position yet. So instead of a clean handoff from one superpower to another, Timcke expect a prolonged period of competition and instability without either country cleanly winning. Another question that we have to ask is how the AI market itself is structured, because that structure shapes how many crises would eventually play out. Right now, a small handful of companies control almost all frontier AI development. We have OpenAI, Anthropic, Google DeepMind, Meta, and xAI dominate this space. That's what economists call an oligopoly, which refers to a market controlled by just a few big players. Normally, you'd characterize an oligopoly as stable with predictable pricing since there's less competition to drive prices down. But AI breaks that expectation. Because training costs are so enormous, companies feel pressure to grab market share even if it means pricing their products below what it actually costs to run them, which is a strange kind of competition because instead of stabilizing profits, it actively destroys them. This sets up two possible outcomes. One, the industry consolidates into one or two dominant platforms, the same way search narrowed down to basically just Google and social media narrowed down to a handful of giants. Two, the losses become too large to sustain, valuations collapse, and a chunk of this AI wealth gets wiped out the same way overhyped .com stocks did in 2001. Either way, everyday workers rarely win in this game. Industry consolidation concentrates wealth and power at the top, while market crashes destroys jobs, pensions, and small businesses, leaving the biggest companies to be saved by investors or government bailouts. None of this is supposed to suggest that AI technology is fake or useless. The argument is about who profits from it, how sustainable the current spending really is, and what this massive investment wave tells us about the state of the global economy. Right now, the numbers show companies burning through enormous piles of cash as they bet on future profits that haven't materialized yet. That's not necessarily proof of a booming, healthy economy. It might be proof of one searching somewhat desperately for its next source of profits after the last one dry out. Whether AI eventually becomes the sustainable industry investors are hoping for, or the latest chapter in a much older story of speculation and crisis, remains to be seen. But according to this research, betting on AI to single-handedly save capitalism from its own contradictions might be a bet nobody should be making with quite so much confidence. If you want to see more videos like this, please like and subscribe and comment your thoughts down below. This is Polity. Let's get to work.